Hello, Deep Value community. I wanted to talk about a little book that beats the market. Joe Greenblatt has been a huge influence on value investors, and I wanted to discuss this book. I assume that you've read it. Um, it's a terrific book, and it's taught me. Joe Greenblatt has taught me so much about investing. Um, so, as you're probably familiar, this website, Magic Formula Investing, offers you some stocks that you can look through, and it's a screener. And the way that the Magic Formula works is that it picks out stocks with two criteria. It looks at cheap stocks on a enterprise value to EBIT metric. So the idea is that the enterprise value, if this has a large debt position, it would be large, the enterprise value, and if it has a net cash position, it will be a small enterprise value. And the EBIT idea is that it removes depreciation and amortization, assuming that capex and depreciation and amortization roughly equal each other. And it also looks at businesses with high returns on invested capital. Now, this part is up for some kind of discussion because return on invested capital, the way that Greenblatt formulates it, is that it looks at working capital. So it looks at inventory and receivables, and it subtracts accounts payable. So there is a bit of wiggle room there, and within this book by Wesley Gray and Tobias Carlisle called Quantitative Value, they have tried really hard to replicate the magic formula, and they massaged the numbers, and they were not able to actually come up with the formula for that Joe Greenblatt does. And in Deep Value, which is a subsequent book by Tobias Carlisle, he actually tries to go further and depict how an investor could really just do away with the high return on equity, high return on invested capital stocks, and solely focus on buying cheap stocks. Now, this is up for discussion, but there is no doubt that Joe Greenblatt's formula has brought up a lot of questions in investors, and it seems to work. Now, this is Gotham Index, and this is Joe Greenblatt's flagship index fund. And you can see that since its inception, it has done very slightly better than the S&P 500. So for investors that were in this index before 2016-17, they were done quite well. But if you've invested in the last year, you've done less well in a down market. Now, you may question and say, no index is going to do better than the S&P at any point and at every point. So the ability for an investor to go through these negative periods is why value investing works. So I don't know. Maybe this formula does work going forward. I do not really solely focus on it, but I do think that it's a very interesting formula, and I hope you found out this video useful, and I hope you'll subscribe. Bye.